welcome to ForexTV.com's PM Exchange. It's Friday, December 21st. I'm Remy Hoki. Today I'm joined by Boris Schlossberg from DailyFX.com. Good afternoon, Boris.
Hi, great to be here as always.
Well, great to have you here at the end of the week.
And almost the end of the year.
Yeah, that's right. Well, as we're ending the end of 2007, in today's session we saw the yen weaken across the board, and we're also seeing a late rally on Wall Street today. So it appears as though we're seeing an improvement in money market conditions. But as we head into even thinner trading in the next few sessions, what technical levels do you see for the Japanese currency against the majors?
Well, we generally think everything is going to be very range-bound for the rest of the year. And as far as the yen goes, yes, you're absolutely right. The flows to the yen and the flows to the stock market are very correlated. We had the return basically of the carry as risk appetite returned all throughout. Nikkei was up, the European bourses were up, and the Dow, of course, helped the dollar yen to go through the 14 handle today. We think generally the 1450 1300 zone is going to be the range of containment for the next couple of weeks going forward. There is a bias to the upside if the stock market is able to rally a little bit into the end of the year. If we have a sort of a Santa Claus rally, that should help dollar yen to the upside, mainly because the yen, as far as interest rate differential goes, is moribund. We saw BOJ stay stationary and pretty much communicate to the rest of the market. They're very likely to stay stationary at least through Q1, perhaps even all the way through the first half of 2008. So there's very little interest to want to get long yen since there's very little interest rate appreciation over there on that side.
Well, Boris, you mentioned interest rates, and one currency that's been affected this week by rate differentials and expectations of rate differentials is the sterling. Following the latest BOE minutes, we saw the British currency pull below the $2 handle against the dollar, and in today's session we saw euro sterling hit a record high at 72.55. So from both a fundamental and technical perspective, if you could weigh on your British pound forecast.
Yes, pound has definitely been the story of the week, and the break of the two handle was very significant. We had been forecasting, we didn't expect it to happen this soon, but it certainly did. It's been basically just driven into the ground by very dour UK data at the front of the week. But today we finally had a little bit of ray of sunshine. UK retail sales bounced back a little bit stronger than expected, and that gave the market a little bit of an inkling that perhaps the BOE may be able to hold off and not have to cut rates in January. The market right now has been operating under the assumption that rates will be inevitably cut in January, and that's why the sterling was so weak. Having done this, though, we think that perhaps we've reached a short-term bottom in sterling, if not against the dollar, then certainly on the crosses. So sterling yen, euro sterling perhaps may have topped out at this point, and we could have a little bit of a retrace rally back to test the two handle next week. We'll have to take a look.
Okay, and what about for your forecast for euro sterling briefly?
Yeah, euro sterling at this point, as we said, is pretty much topped out at the 72.50 level. It's at a 4-year high, and the interest rate differentials between the two is really being driven by the idea that BOE is going to cut rates to 5% by January. However, that's still very much an open question. And on the other side of it, ECB, even though they have been talking very hawkish, they really are unable to do anything because there's a huge bifurcation between what's happening on the price level, where prices are going up, and what's happening on the consumption level, where consumption is contracting continuously in the Eurozone. So for those reasons, the ECB, regardless of how hawkish they are on their price forecasts, will have to stay stationary, at least in January, perhaps even through Q1 of 2008. As the market begins to realize that, euro sterling is going to lose a lot of its oomph, and it's probably going to peter out at these levels.
And while we're still talking about the euro, let's move on to the euro against the U.S. currency. It wasn't too long ago that euro dollar hit a record high at 1.4966, which was on November 23rd. But as we near year end, we're seeing a dollar gain against the euro. In today's session, it is around 143.50 to 143.60 level. So going into the next few sessions in holiday thin trade, what are your levels of support and resistance?
Yeah, it certainly seems that as we come to the end of the year, it's much more likely that we go to 140 on the euro down than we go to 150. The dollar has really strengthened against the euro over the last couple of weeks, but we still think it's very much range bound. For the next couple of weeks, we don't see, there's very little economic news. There's little to drive trade at this point. Almost everybody has closed their books, and we forecast a range of 143 to 145, pretty much contained. Last several years, we've had a lot of volatility in these very thin liquid market conditions. But we think that this year that's going to be different, mainly because everybody who's already wanted to express their opinion has done so over the last several weeks. And now barring any major geopolitical events or big economic surprises, we don't think too much movement is going to happen in the pair for the rest of the year. As a matter of fact, we took a sample of our own book today, and just to give you an idea of how divided the opinion is, we have the exact same amount of shorts as the exact same amount of longs on euro-dollar for the first time to the account in a long, long time that we've seen that. And that just shows you the absolute equanimity of opinion on the pair at this point.
Okay, and last but not least, if we could shift our focus over to the so-called commodity currencies, focusing on the Aussie dollar and Kiwi dollar first. And we saw the dollar come off against the Aussie and Kiwi in today's session. So from a fundamental perspective, and also if you could briefly touch on your levels for Aussie and Kiwi against the dollar.
Yeah, I think, the commodity currencies are the story. The commodity currencies against the majors are probably the story of the week as we go into the end of the year, mainly because on a relative strength basis they have performed well. The Canadian dollar is being supported by $93 oil. Australian dollar is doing well because gold is still holding the 800 handle more or less. And Kiwi had very good GDP data. What it's all saying to you is that the relentless demand for commodities across the world, the growth of the world, is just creating very, very strong support underneath those currencies. And long term, you have to be bullish those currencies until that dynamic changes. Basically, a bet on the commodity currencies is a bet on global growth going forward next year. And so far, that bet has really paid off.
Okay, and last but not least, if we could take a look at this morning's U.S. data, we had personal income and spending, and also the University of Michigan Consumer Sentiment Index come out. So taking a look at the consumer here in the U.S., and there's been plenty of talk of whether we're heading for a recession or if we are in a recession right now. So Boris, going forward into 2008, what do you think we need to keep our focus on?
Well, we don't believe we're in a recession right now, and we've been skeptical of the argument that we're on the verge of tipping into one at this point because so far data has really not shown it. That having been said, we are becoming extraordinarily cautious. There are a couple of data points that begin to worry us. First of all, jobless weekly claims have ratcheted themselves up to 346, very, very troublingly close to 350 level on a weekly basis. The other thing that I saw today that kind of really caught my eye was that restaurants, especially steakhouses, which is a key sort of a tell sign of discretionary spending, have all warned this week, and all their stocks are down tremendously. And that to me shows that perhaps the consumer is scaling back. It doesn't quite say that we're on the verge of contraction, but we certainly are in a period of slowdown. For us, it all comes down to jobs. As long as NFPs can print 100,000 or better in the next several months, we will avoid recession risk. If we start to see a materially contracting job picture, then yes, the bears probably are going to be correct. We're going to see a recession in the near future, and that of course is going to impact the dollar very badly.
Okay, Boris, as always, thank you very much, and have a great holiday season.
Thanks again. It's great to be here as always. Best of holidays to you.
Happy holidays.
Bye-bye.
This has been your Forex News with Boris Schlossberg from dailyfx.com. Now we have your equities and commodities wrap up for the day. U.S. stocks rallied today with the major indexes seeing a gain of over 1.5%. Wall Street cheered the stronger than expected report from Research in Motion. RIM reported that fiscal Q3 profits more than doubled. Meanwhile, there is news that Merrill Lynch may be receiving a capital infusion of as much as $5 billion from Singapore's Temasek Holdings. In today's U.S. economic data releases, personal income rose 0.4% in November, while personal spending gained 1.1%. That was the biggest rise since May of 2004. And October spending was revised to 0.4% from 0.2%. Meanwhile, the core PC deflator rose 0.2%, but core inflation climbed 2.2% on a year-over-year basis. And the final December reading of the U of Mich Consumer Sentiment Index fell to 75.5, which came in better than forecast. At the closing bell, the Dow Jones Industrial Average advanced 205 points, closing up at 13,450.65. The tech-heavy Nasdaq gained 51.13, ending at 2,691.99. And the S&P 500 added 24.34 points, closing up at 1,484.46. In the fixed income market, U.S. Treasury bonds fell in today's session after rallying in the previous sessions. Investors moved into equities on bargain hunting following the recent sell-off. The benchmark 10-year Treasury note fell with its yield up at 4.17% from 4.06% late Thursday. The 30-year bond fell with its yield up at 4.57% from 4.49% in yesterday's session. The 2-year note also fell today with its yield at 3.19%. And in energy, crude oil futures gained 2.5% on the day. Prices gained following the latest U.S. consumer spending data, which surged by the largest margin in over 2 years. This eased concerns about a slowdown in oil demand. February crude gained $2.25 to close at $93.31 a barrel on the NYMEX. Although crude oil prices were higher in today's session, trading volumes were thin. And in petroleum products, which also saw gains, January heating oil rose 1.96 cents to close at $2.6091 a gallon. January RBOB gas futures gained 5.19 cents to settle at $2.3795 a gallon. Meanwhile, January nat gas futures added 5.3 cents to settle at $7.19 per million BTU. Over in the metals complex, COMEX gold futures rallied 1.6% on the day. This came as the U.S. dollar saw weakness against the euro and the commodity currencies. Also, crude oil prices supported demand for the precious metal today. February gold hit a session high of $816.30 an ounce, and the benchmark contract added $12.20 to settle at $815.40 an ounce. In other metals, March silver added 14.80 cents to close at $14.488 an ounce. January platinum rallied $18.80 to close at $1,536.30 an ounce. And March copper added 13.2 cents on the day to end at $3.0975 a pound. Now we're joined by Derek Fry from ONF Futures and Options. He'll give us his short-term outlook for energy and metals futures.
Okay, recapping the action we saw this week in the energy and metal sectors. I'll start with the metals. We did see a bit of a rally today in both gold and silver. Not a major surprise there. As I mentioned earlier in the week, we've reversed our position. We had been selling rallies and covering below 800, and now we're actually buying dips below 800 and looking to unload them on rallies like we saw today. So, that being said, we continue to build a long-term core position below the 800 level, looking for a run up to the Hunt Brother highs, the 1980 highs, as well as possibly getting through it and testing the $1,000 level. I think this year of 2008 could very easily be the year that we test that $1,000 level. So, look for the overall buying of dips to be the best course of action here over the course of the next few weeks and months as we go forward. Kind of the same story in silver, frankly, as well. Looking to buy dip. Silver, I think, has a lot further to go relative to gold in terms of achieving the highs from Hunt Brother highs. The Hunt Brother highs for gold, of course, were north of 800. For silver, they were north of $50. We still haven't even gotten anywhere close to $20 in silver. So we really, in terms of upside magnitude, like I said, silver has a lot more potential than gold does as we look forward. So keep that in mind. Moving over to the energy sector, we also saw a pretty strong rally, a couple hours in crude oil today. As I've been saying here as well, we've continued to buy dips below $90 and continue to look for a move to test the old highs and ultimately print the mythical $100 level that everybody's so hot to trot about. I think you will see that probably printed as early as sometime next week while no one's paying attention, or at the very latest within the first couple of weeks of January. But bottom line there is continue to buy pullbacks in energy. And metals for that matter. So want to wish everyone a happy holidays and look forward to seeing you all back on the other side of the holiday.
Okay. That was Derek Fry, head trader at ONF Futures and Options, with his commodities commentary. Thanks for joining us for today's edition of PM Exchange. I'm Remy Hokie. Tune in Wednesday morning on December 26th for your latest news update right here on ForexTV.com. From the entire team here at Forex TV, we wish you a safe and happy holiday season.